This is actually the first time I'm giving this talk, so I'm excited to give it. Um, Welcoming any feedback afterwards as well. It's titled Stablecoin Operating Systems: How to Build Money Moats. I'm the VP of Comms at Frax, which is a stablecoin provider. We're coming up on 5 years in DeFi, so we've been around for a long time. So I think everybody in the audience probably knows about stablecoins, so I'm not going to spend too much time talking about stablecoins. Just this one slide, really. So originally, stablecoins were created to address the need for a liquid dollar reference for on-chain crypto trading. But of course, stablecoins have grown to become much more. And some of the initial high growth areas when you introduce a product to the market is where they make the biggest impact. So for stablecoins, that was access to the US dollar in markets where local currency was less stable, as well as remittances where fees are traditionally very high due to the friction of moving money between countries. But now stablecoins have clearly entered into a new phase of growth where they're crossing the chasm into everyday use cases because digital dollars are ultimately much more efficient. They're faster, they're cheaper, they're 24/7 settlement, they're able to move around the globe very easily, and of course, they're programmable and they're interoperable. So I provided two charts here. One is the stablecoin transaction volume of stablecoins versus traditional systems such as PayPal, remittances, Visa, and ACH. And you can see back in 2024, the stablecoin transaction volume actually crossed Visa's transaction volume, which is pretty impressive. And then this other chart is a projection from Coinbase. Both of these charts are from a Coinbase research report showing the expected growth of stablecoins surpassing 1.1 trillion in 2028. So very high growth area. Why is there so much growth coming right now? Well, Genius was passed in the US, and Genius is about to change everything when it comes to stable coins. Because previously we operated in a regime that had regulatory uncertainty, a patchwork of regulations, but for the first time, Genius is going to provide regulatory clarity for US stablecoins. And immediately this will split the stablecoin market into two categories. One, which is Genius compatible. And these are the ones that are going to be able to be integrated into the payment system. This means that digital dollars, which we discussed prior, are better than traditional dollars for a number of reasons. So the total addressable market for stablecoins is, you know, all money essentially. So it's tens of trillions of dollars today. And in order to be accepted in the payment system, you're going to have to follow these Genius requirements. And then there's going to be non-Genius compatible stablecoins, which will still have their place in in the market, but they will be more niche. They will be around certain types of yield that people want to get exposure to, and they can represent those with stablecoins, and they can grow in value over time. But it's really a different market, which will also grow, but it will be nowhere near the order of magnitude of Genius compatible stablecoins that are going to be introduced into the payment system. So some of the requirements around Genius include having one-to-one backing and reserves. So these stablecoins need to be 100%, often over 100%, so that, when there's exchanges happening, that you still maintain that over collateralization of cash and short-term treasuries. And then there's also strict reporting and transparency requirements. There are a number of other things in Genius, but this is the most important part that many stablecoins today do not meet. A lot of stablecoins today, they're backing themselves partially with instruments that are either longer dated or they're crypto backed to some extent. Even Tether today backs partially with gold and partially with Bitcoin. And so in order to become compliant with this law, everything needs to be backed by cash or short-term treasuries. So it limits the duration risk and makes things safer. So a quick introduction on Frax. We are a protocol that's issued stablecoins for 5 years now, with multiple products reaching over 100 million in total value locked. We're known for building a working algorithmic stablecoin and one of the highest yielding ETH stablecoins. So an algorithmic stablecoin is a stablecoin that is partially backed by crypto. So an algorithmic stablecoin would not qualify under Genius. And part of Genius being introduced into law was to address the issues with algorithmic stablecoins, as there were some algorithmic stablecoins that were high risk, and as a result, they ended up depegging. And once you depeg, it's very hard to re-recover your peg. And so the most famous incident was with Terra, where it went to zero essentially. And there was a lot of money invested in that stablecoin because people believe that a stablecoin should be a dollar. And so originally people were very comfortable holding them until these issues. And that's what Genius tries to address. We also have a suite of products that support these stablecoins. So Frax Lend for lending and borrowing, Frax Swap for swapping between stablecoins and other stablecoins or other crypto tokens, Frax Ferry, which was around moving assets across chains, and more. But we overhauled our entire offering when we saw the Genius Act coming for the reasons we stated before, which is that there is so much growth coming into tokenization and stablecoins. And in order to unlock that, you have to be compliant with the laws from the country where that currency is issued in the first place. And if you are, then you have the ability to have a slice of that pie that is going to grow exponentially. So we recentered our entire offering around a new flagship stablecoin called Frax USD, which is built to the Genius standard, and that was released this year. And we've supported Frax USD with what we call the first stablecoin operating system. And it's not going to be the only stablecoin operating system. This is a strategy for how you can have opinionated design around your stablecoin while still being interoperable and still being secure. So the main two things you need in a stablecoin operating system is one, you need your stablecoin, which for us is Frax USD, which is Genius compatible. And then two, you need your own chain. And having your own chain means you own the rails on which it's issued and which it moves around. And when you own the chain underneath your stablecoin, it unlocks a lot of efficiencies and opinionated design around how your stablecoin is able to operate. So I've listed some of the things here that we do. One is we have a hub and spoke model. There are a lot of chains right now, and in the future, chains will consolidate just due to network effects. But at the same time, there's always going to be a number of chains that are systemically important. So it's really important you have a way of natively issuing back and forth across those chains in a way that's secure, fast, and cheap. And so one of the things we've done is since we have our own chain, we can operate our chain as a hub chain. And when our assets are moved from one chain to another chain, it goes to our chain first and then out to that chain. And that way we don't have to deal with 1,000 different, n squared connections between all of these different chains. It just always goes back to our chain first and then out to another chain. So that unlocks greater efficiency in cross-chain interactions. Then we're able to make our chain very high throughput and low cost, which allows us to do interesting user things like sponsoring gas. So when you're sending our stable coin around on our rails, it's already cheap, but we're going to make it free. And then real-time rewards as well. So on our own chain, we distribute rewards for holding our stablecoin, and that right now is done on a daily basis if you sign up for it. But in the future, as we increase throughput, that can be done block by block. Novel incentive mechanisms as well. We've designed a point system that exists on our chain that looks at the network effects of different smart contracts on our chain and then rewards them points, which will eventually be tokenized. It operates similar to the Google PageRank algorithm, where like smart contracts that interact with the most users on the chain get a weight that is a multiplier that gets them more points. And then we have a growing ecosystem of DeFi projects on our chain, which support our assets. You have greater alignment with your partners, with potential to become validators. And then everything that's on our chain burns our ecosystem token Frax, which creates alignment around our offering. So some of the other stablecoin stacks that you'll see out there. So ours is Frax USD built on Fraxtal. And then Circle has USDC, which is their chain is basically Coinbase's base. And then you have Tether, USDT. They don't have a singular chain, but there are a couple chains competing to be the Tether chain. Those include Tron, Stable, and Plasma. And then the last piece I'll add to our stablecoin operating system is that we have the asset and we have the chain, but how do everyday people access it? And so we built something called FraxNet, which sits on top of that infrastructure and allows you to log in with a username and password and mint, redeem, and earn with our stablecoin so that you don't have to interact directly with the smart contracts. It just operates as a normal fintech platform. And then we use that not just for consumers and retail who wants to access it, but also all of our partners sign up as well to be able to leverage that infrastructure and access the liquidity as well as the benefits of the chain. So, what is really important when you're building a stablecoin? I think the top three things are security, transparency, and interoperability. So, number one is security. You can't be a stablecoin if you're not stable. And so it's really important that in everything you do, you have a very rigorous security auditing program and a flawless track record over time. We've been in operation for 5 years and we have had no smart contract issues that have resulted in loss of user funds. And so if you were to start a stablecoin today, you might have the same amount of security, but some amount of security is trust built over time. So we have a 5 year head start on anybody starting today in terms of a security track record. The second thing is transparency. This is like one of the tenets of blockchain is that you can go and verify that all the funds are where people say they are. And it's pretty surprising that even with the transparency of the blockchain, many stable coins that you see, they don't publicly publish their addresses. They'll publish some sort of report or an attestation, but certain things are kept off chain or they have, commitments elsewhere. And so, they have an auditor come through and that's totally fine. But for us, we believe that everything should be on chain. You should be able to click into it and see the balances. And so we have this transparency dashboard online. This one's more like pretty, I would say. It doesn't have the like addresses to click in, but online we also have all the contracts. You can click in, see the balances versus reserves versus what's in circulation, and we have that on 20 plus chains. And so that's very important to us that you can always verify that. And we also have third-party verifications as well as audits as well. Because even though things might be on chain, you might have committed that capital elsewhere. So you need an audit to be able to determine that that capital is indeed reserved for the holders of the stablecoin. And then the last point is around interoperability. There are a lot of stable coins that kind of exist in their own ecosystem, but they never branch out into other chains or other projects. And that's totally fine. If you own the distribution, you can have a stablecoin that's just in your own product because stablecoins have greater efficiency. You're unlocking that by providing that to your users. But for Frax, we want to operate as an interoperable stablecoin that's able to connect between all of these ecosystem stablecoins and provide central liquidity and efficiency there. So we also think that you need to take a lot of bets in terms of which ecosystems you're going to be in. And it's very hard to choose the winning chains as network effects are built over time. And these things take a long time to play out. So we believe in being, in all places rather than, just one place and expecting that to be the winner. So we, through Layer Zero, which is an interoperability solution, they've really solved the cross-chain bridging concerns that have existed in the marketplace. Bridges traditionally have been a large security issue for assets because traditionally with bridging, you'd have to wrap your asset as you go to a new chain. And that creates basically a honeypot where you have a bunch of your assets sitting in the bridge and then you're wrapping it on the new chain. And then hackers target the bridge and drain the bridge and then a lot of your asset can be depleted in one go. What Layer Zero solves is they have cross-chain messaging, which allows you to natively burn and mint your asset on chain. So there's no wrapping that's happening where your assets are sitting and collecting in a bridge and then they can become a target. It's actually natively burning and minting on these new chains. And as a result, it's much more secure, and they've built a really great platform for doing this and for validating the security of it. It's also open source, so we actually run our own instance of it to have complete control over the system. And I provided this graph in the bottom right. Over time, Frax USD was launched at the beginning of this year. So you can see over time an increase in what these are messages. So a message is when you transfer from one chain to another chain, and you can see that number growing over time. But what you can also see is that gray is our own chain, Fraxtal. But over time, you can see that a lot of the messages are coming from other chains as well. And so that's kind of the network effect model, where rather than just choose one chain, you're in a lot of different chains, and you can see some chains grow over time and shrink over time. But ultimately, if you're a very liquid asset amongst many different chains, people become start to rely on it as a means of exchange, which is very important when you're building money. So from a partnership perspective, I really like this quote. If you want to go fast, go alone. If you want to go far, go together. Institutional sales cycles are very long, and that's what we're building for. And so it's a different game than we're used to in DeFi. Some of the use cases that we're talking about are digital asset custodians who are looking to offer rewards for their stablecoin holders. Real world asset providers, the tokenization of real world assets is something that's also growing very quickly. And one of the largest use cases of real world assets is tokenized treasuries. And that's what we use to back our stablecoin. Where some stablecoins might say, we're just going to use one type of tokenized treasury, we're open to all of them. So we work with BlackRock BUIDL, Wisdom Tree WTGXX, Superstates USTB, all these different types of tokenized treasuries from very trusted institutions. And we view that as, a strength because all of these different partnerships, they lead to increased opportunities to work with and network with these institutions. And we've found different partners who want to work with each one, and having all of those available allows us to always be able to deliver what our clients are asking for. Investment banks looking to unlock greater capital efficiency for idle capital. There's a lot of treasury management that happens where stable coins or what would normally just be cash sits idle. But because we're able to offer rewards for holding Frax USD, they can hold our stablecoin, and then we can make that capital more productive for them. Stable coins as well. Other stable coins who are looking for the best rewards in infrastructure, pretty much every single company right now that has a large user base and has cash on hand is considering whether a stable coin makes sense for them. But a lot of them don't have the in-house expertise. And so they would look to someone like us to help them issue a stablecoin, essentially a wrapper on top of our stablecoin. But the thing that makes our offering the most attractive is that we're able to forward on the underlying rewards to them. So if they were to work with like a USDC, they would get the benefits of stablecoins, but they wouldn't be getting anything on top. The underlying yield from the treasuries would be going to Circle, the corporation. And so we believe that, if you're getting the distribution, you should also get the rewards of that distribution. So that's the positive sum model. We're seeing it with real estate transactions where you have capital locked up again, and you want that capital to be productive at all times, as well as crypto native investors who keep more of their net worth on chain. They don't want to go back into traditional fiat in order to make payments. And so this allows everything to happen on crypto native rails settlement times are much faster, and you're able to make it programmable. And then finally, novel payment networks and privacy. Crypto is all about disintermediating existing players that take a fraction of the world's economy. And so one of some of the most interesting applications are people who are essentially trying to create a disruptor for like a Visa, for example, which seems like an impossible task based on the market share they have, but they're also taking, 2 to 3% from every transaction. And so if you can find a way to fully settle natively on crypto rails, you can save merchants 2 to 3%, which is meaningful. And yeah, so this positive sum mentality is how we approach business in general. The pie is growing so much with stablecoins. We're at 250 billion right now. As we mentioned, the projections are going to be over a trillion in, several years. So, you're doubling every couple years, which is a ton. So every partner helps build a stronger ecosystem here, and we'd rather grow than try to take as much upfront. And as a result, we're able to work with a lot of different people. One growth area which is really interesting that we're seeing is neobanks. So neobanks were already a high growth area in terms of off-chain neobanks. So Nubank, Revolut, Monzo, those types of companies who are disrupting the traditional banking industry by not having a brick and mortar offering, by having much more lean operations, and operating mostly through an app or online. As a result, they're able to have better unit economics than traditional banks. But now we're seeing with crypto that there's actually another unlock that's happening with on-chain neobanks. And with on-chain neobanks, not only are you upgrading the, brick and mortar retail facing aspect of it, you're also upgrading the back end to crypto native rails. And as a result, what traditionally took hundreds of people to manage can now be accomplished with a handful of people and really good code. It's a super competitive field, though. There's a lot of people who want to play in this space. It's very close to the end user. You're trying to get end users to set up, direct deposits for like from their work into your platform and then offer them a bunch of benefits in terms of, maximum rewards on their cash, rewards back on crypto-backed credit card, things like that. And again, we're taking a positive sum approach here. You can use our Fraxnet platform to deposit stablecoins and earn on them, which essentially makes it like a neobank, but that's not really where we're trying to compete. We're working with the neobanks themselves to power their offering, to give them back more of the unit economics. Again, we believe that if you have the distribution, you should get the rewards. And ultimately, by partnering with all of these organizations, this leads to network effects and monetary premium of our infrastructure and assets. Monetary premium is one of the hardest things to accomplish as a stablecoin provider. Today, in the stablecoin ecosystem, almost every stablecoin is incentivized by like token emissions of some sort. But really, what you want to have is people who hold your stablecoin with no expectation of token emissions or no expectation of rewards beyond what is existing already, like the tokenized treasury backing. And the only way you can do that is if people trust it, if it's very easy to use and spend wherever you want. It's the equivalent to holding cash in your wallet. That is what monetary premium is. You're holding money without expectation of the yield that's possible to get from it. So I'll end with this, which is, should you build a stablecoin? And I would say that it's very hard to build a stablecoin. Hopefully, the presentation gave you a sense of, the history and the architecture required and the competitive nature of this industry. A business started today with the sole purpose of issuing stablecoins is going to have a really hard time. But stablecoins are useful in every single business they can just improve the efficiency of existing treasuries. Uh, they're useful in payments, banking, investments, retail. And so any large business that owns distribution to the end customer is thinking about leveraging stablecoins. We are going to see in the next several years a Starbucks USD, a Walmart USD, any of your favorite store brands, you name it, they're going to be using stablecoins to help both, unlock greater efficiency in their internal operations, but also externally create a brand around the money that exists in their system. Just like today, you see, airline points and uh, just point systems for rewards, for loyalty, that kind of thing. Uh, all these brands will have their own form of money, but only a handful of these stablecoins are going to be integrated at the payment processor level. And so you're not going to see, a one-to-one exchange between Starbucks USD and Walmart USD. What you're going to see is Starbucks USD is going to change into a one of the handful of stablecoins that's accepted at the payment processor level, where there's deep liquidity, where there's deep interoperability and connections, and then it's going to go out to the other stablecoins on the edges of the network. And so we're intending to be one of those stablecoins that operates at the payment processor level and has deep connections throughout the payment system. And that's the presentation.
Right, I'm going to ask the first question. What advice would you give to the UK regulator for you? What should they do for you to consider to launch a British pound stablecoin?
Yeah, so I knew there'd be some questions about regulations because when it comes to issuing currency, right, you can't do that without regulations, and that's why I covered Genius because it's so important to have the regulator of the currency, you know, state what they want in that stablecoin. So the regulation in the UK is very difficult to navigate at this time, which is why we're not pursuing a pound at this time. But we are open to issuing other currencies. And one example of that is we are partnered with IQ, who has issued a Korean won stablecoin called KRWQ. And that is actually built on top of our Fraxnet infrastructure and smart contracts. So essentially, what they're doing is they're issuing a Korean won stablecoin that's currently backed by USD, but eventually will be backed by tokenized Korean treasuries. And all of that is able to interoperate with our existing system. That's just how the smart contracts are flexible. So from a technical standpoint, it's totally doable. But from a regulatory standpoint, yes, very challenging.
Okay, if anyone has any question, please come forward. And because we don't have a microphone, you have to come forward and ask a question here at the laptop.
Can we make use of your network or Frax stablecoin and launch another stablecoin in a different country?
Yeah, that's exactly what I was describing with KRWQ and the Korean won stablecoin. It's definitely possible.
Thank you.
Hi. One of the points you mentioned in your slide was the one-to-one ratio of the backing for stablecoin. I was wondering how you're able to do that because the Fed, for example, for the dollar, doesn't provide that.
You mean like traditional banking isn't one-to-one banked?
Yeah, the Fed in the US, for example, I think is up to like 250K they can guarantee.
Oh, yes,
But you
yes.
offer that
So,
one-to-one, so I want to know how
yes,
that's
what
able
you're
to do that.
referring to is insurance. The FDIC insurance in the US is up to 250K per bank account. Traditionally, they have backed beyond that in issues where banks have had liquidity issues. They've stepped in and protected more than that for retail, as they did with Silicon Valley Bank when it collapsed. But yes, so that is something that is available on bank accounts in the US. Insurance is not something that comes natively with stablecoins, nor is it a requirement under Genius. The one-to-one backing ensures, uh, barring smart contract risk, that your assets are always bank backed, and so there is no risk of depeg due to lack of backing. Whereas in the banking system, you have issues where they're loaning out more than they have. It's fractional. And so you can have a bank run on traditional bank accounts, though it's very rare. It's just a duration mismatch in terms of timing. But for stablecoins, that's why Genius states that stablecoins under Genius, they have to be one-to-one backed and they have to be backed by extremely liquid cash or short-dated treasuries.
Hey there. Thanks for the talk. I have another question on Genius. I would say for me, Genius is not important, but Mika is. How can I square these two? Like, how can I, operate a token that is kind of helping me with Mika? Do I have to choose one of the two, or what's your view?
Yeah, I'm not a regulatory expert. I would definitely recommend if you're operating in Europe to look at Mika. Our view is that for dollar stablecoins, US dollar stablecoins, we are looking at the US regulations for the dollar. Uh, we would hope that eventually Mika would come to reflect the US guidance for regulatory guidance for dollar stablecoins, as the US is the issuer of those dollars. But yes, there is regulatory discrepancies between those two, and that is something that will need to be addressed.
Can I ask a question about all the different, as you say, like a Starbucks doing their own stablecoin and Nvidia doing their own stablecoin, and then Facebook will do the same. How do you see its impacts, like your work, and also um, how do you see the future when it comes to every single company doing their own stablecoins?
Yeah, so I think overall it's just great for stablecoins as a industry for more companies to realize the benefits of them. The main issue is if there's not, this central liquidity of stablecoins, that you can end up with uh, issues going from one stablecoin to another, and liquidity mismatches. But yeah, it's a problem that's going to be solved by this handful of stablecoins that sit in the center and connect to all of them. So overall, I'm excited to see these companies try new applications for their dollars, and it will allow investors to make more opinionated decisions with their money. I think that's already happening in many ways with retail investing, but the ability to hold your money with a brand that you trust has very interesting implications as well.
A final question. Please come forward to that one. Or actually, can you use the Hey, yeah, that was very interesting. I sort of on the same sort of theme. I'm kind of interested in your views on the sort of regulatory landscape in the US versus UK and Europe. In the in the US, they seem to be quite chill about the deposit flight problem and the idea of passing on yield. And I kind of, and obviously in Europe, this is like the number one concern. And I can see, that there are kind of real concerns here in terms of could like stable coins with yield be something which actually induces a banking crisis? And so I suppose my question is, do you think this kind of idea of passing on yield in stable coins is actually kind of sustainable?
Yeah, it's definitely an interesting development. And Genius does not allow for direct passing of yield to holders. The banking industry is looking into like completely removing all loopholes. Basically, right now, you can't have a stable coin that increases in value due to the yield underlying it. It has to be pegged to $1. Right now, there are yield stable coins which increase in value over time as they receive yield from their underlying backing. So Genius, it has to be $1 flat. But you can give rewards to people who are holding them. So that's the concern that that competes with banks. I think banks play a much like larger role and have much more functions than just providing a dollar. That's the argument in the other direction. They're also going to eventually tokenize bank deposits, I think, and so that will also provide more value beyond a stablecoin. I think stablecoins are really useful in payments. Um, so yeah, it's definitely an evolving piece of the regulations. I do think the banks will be fine, but yes, there will definitely be some growing pains as technology is disrupting.
Thank you for a really amazing talk and for answering our questions. Thank you so much.
Of course.
Okay. Thank you. Bye. Bye.